Okay, with this we go to banking regulation. Uh, Banking regulation, as from the earlier brief introduction to the institutions and the legislative uh, framework of the regulation, banking regulation, uh, we all understand, refers to the regulation of institutions that give banking services. Again, let's start with um, the regulator and the regulated before we go deeper into the discussion. Uh, the regulator is the National Bank of Ethiopia, the NBE, and the regulator are banks, basically. Now, what is the National Bank of Ethiopia? This National Bank of Ethiopia was established in 1963. The establishment proclamation we referred to earlier, Proclamation 593, is actually a revision of that law. But the National Bank was not established in 2008. It was established in 1963. What's the nature of the National Bank of Ethiopia? It's very interesting to look at the exact structure and nature of the National Bank of Ethiopia. The National Bank of Ethiopia is an administrative agency in a way. Like many other administrative agencies, it's an administrative agency mandated with some public power, public objectives. But not only that, the National Bank is also a profit-making institution. Like many other central banks, the National Bank of Ethiopia is a profit-making institution. It does, or it makes profit by providing banking services. To whom does it provide banking services? Basically to the government. The National Bank is the banker of the state. Like any individual can have a banker. The National Bank, the government also has a banker, and the National Bank is the government's banker. The National Bank is also a banker of banks. Financial institutions, banks, insurance companies. They get services from the National Bank. The National Bank lends money to commercial banks, or rather, Development Bank of Ethiopia, for example. We in Ethiopia, unfortunately, have only commercial banks. There can be many other banks, like previously we had actually a mortgage bank. We can have investment banks in the future. It's a must now. Capital markets coming. So the National Bank therefore lends money to banks. When banks have shortages of money, the National Bank lends to them. And the National Bank also takes deposits from banks. Every bank, every commercial bank is required to deposit money in the National Bank. The National Bank also does clearing and settlement services for banks. This intra or interbank loans, interbank clearing and settlements in relation to checks, for example. When you have a check from Bank of Abyssinia and deposit that check in let's say Awash Bank naturally does not have any obligation to receive this check drawn or issued or checks originating from Abyssinia Bank. How do they make that transfer of the money from Abyssinia to Awash Bank? Is through this interbank clearing and settlement, which is facilitated by the National Bank of Ethiopia. So these different services provided by the National Bank give rise to profit-making activities, and therefore the National Bank is a profit-making institution. Many central banks in the world are profit-making. A very good example is the Swiss National Bank, which some 2 years ago made $54 billion in profits only. So no exception to this, the National Bank of Ethiopia, that it makes huge profits, and it's also authorized by its establishment proclamation to do those services and to generate profits. But the most important function of the National Bank is its regulatory function, not its profit-making function. So the regulatory function of the national bank has two important aspects. One is monetary regulation. The other is financial regulation. Actually, our subject is financial regulation. But let's say a few things about this mandate of monetary regulation. Monetary regulation involves regulating the supply of money on the market. The national bank controls have as one of its primary objectives the control of supply of money on the market. If money supply on the market is more than necessary, then it will have inflationary effects on the market, and that's not what the economy requires. So how does the national bank control monetary supply, or how does it exercise monetary regulation power, usually referred to as monetary policy power? There are two ways. If you look at literature in finance, in monetary policy, there are two ways. One is direct monetary policy instrument, direct instruments, and the other is market-based instrument. So direct instrument relates to, for example, controlling interest rates. So if you control interest rate, you can control inflation. You can fix interest rate, deposit interest rate high, so that people will be motivated to put their money in banks, so that there's no much money on the market. The other direct monetary policy instrument is this reserve requirement, by which is meant that the national bank requires commercial banks to reserve a certain amount of their deposit liabilities with the central bank. That means that they will be limited in their credit giving wing of their service will be limited, so that they can't lend all the money that they collect in the form of deposit. They have to set aside a certain amount, which is known as reserve requirement. So when the reserve requirement is high, it means that the amount of money that they can lend compared to the amount of money they deposit, the collective deposit, will be limited. If the reserve requirement is low, then they can lend more money, and so there will be more money in the market. So this interest rate regulation and the reserve requirements in combination work towards limiting or increasing the amount of money supply on the market. So this is said to be direct monetary policy instrument. The other is market-based monetary policy instrument, which is actually typically treasury bill sales. The national bank sells treasury bills for different lengths of times, like 28 days, 90 days, 180 days, and so on. So treasury bill is a system of collecting money from the market. It's a system of draining money from the market. So depending on the monetary situation in the country, the national bank uses this both market-based sale of treasury bill or direct reserve and interest rate control mechanism. It monitors or regulates the amount of money supply in the market. But this is an issue actually that lays outside the ambit of our discussion. Let's come to the other important mandate of central bank, which is financial sector regulation. Financial sector regulation has different objectives. By financial sector regulation, we mean the regulation of financial institutions. Here we are now talking about banking regulation. There are different objectives for banking regulation. The most important of these objectives is prudential objective, or generally the regulations known as prudential regulations. There are also other objectives, like consumer protection objectives, competition, fair competition objectives, and other objectives like financial inclusion and preventing or fighting money laundering and terrorist financing. So, financial sector regulation, especially the banking regulation, has these four primary objectives. But the most important among this is prudential objectives. Um, what's prudential regulation? Prudential regulation means regulation intended to make banks prudent, careful, um, you know, foresighted in what they do and in how they do what they do actually. So that's what is said to be prudential regulation. There are different approach to prudential regulation: micro prudential regulation, macro prudential regulation, but that's not very important for us. For us, the most important point is prudential regulation is a type of regulation intended to make banks careful, very careful in what they do, because the money that they collect belongs to the public. So the failure, the bankruptcy or insolvency of a bank entails severe consequences, damage to the economy. Because of this, regulators around the world have developed this concept of systemic risk, because it is this